Will April showers bring May flowers? That's coming up on today's edition of 3 Minutes on Markets and Money. So April turned out to be a real bummer as markets slid sharply from those March peaks. And again, after a decent reflexive rally in the month of March, April really getting very oversold here. Investor sentiment extremely negative. In fact, we have some of the lowest investor sentiment since the 1970s. Technically speaking, and again, if you take a look at our weekly newsletter, which is on our website now, realinvestmentadvice.com, just simply click the newsletter link. In that analysis, we have a chart of our technical gauge, which is a composite technical indicator of a variety of technical measures, all compiled into one weekly index. That index is now at the lowest level since March of 2020. The point here is that markets are very oversold, very negative, positioning also very light, really kind of across institutions and managers. Markets now very oversold here, and this is not surprising given this recent sell-off. As we get this oversold, this is typically where investors typically start making bad investment decisions, want to sell out of their market portfolios, etc. That emotional driven response by declines in markets lead to bad decisions, often, more often than not. Can the markets go lower from here? Absolutely. Right now we're trading about 2 standard deviations below the 50-day moving average. Unfortunately, the bad news here is the 20-day is getting ready to cross back below the 50-day. That's going to provide some very stiff overhead resistance at this level. So again, we could see a rally here in the short term. That rally likely to be a bit of a lower high than what we've seen previously as we continue to really establish this downtrend in the markets. So a rally back to that crossover level of the 50-day is about where we would expect the top of that downtrend rally to be. That would also turn up this oversold buy condition here and give that market some lift. Again, can markets go lower from here? Absolutely. We could see a retest of these Russia invasion lows, which would also be down here in 3 standard deviation territory. Again, not an area that we get into often without having a reflexive rally. We did it here back in early January when we initially had that sell-off, got 3 standard deviations oversold, market rallied back. We did it the same again back here where Russia invaded Ukraine, got a reflexive rally again. So as we start to flirt back with this 3 standard deviation territory, a rally from here, not surprising at all. Now, as we get into the month of May, we have stock buybacks that are coming back. That window opens up today. So again, corporations can start buying back about $5 billion a day in terms of stocks. That'll help give some lift to stocks through about mid-June. So again, there are some reasons here short-term to expect a rally. Importantly, though, that rally should be used to lighten positions, reduce risk. We've got a lot of stuff going ahead of us over the next month or so that could certainly weigh on markets, particularly as the Fed becomes more active about reducing their balance sheet, hiking interest rates. So use a rally to reduce risk and rebalance your allocations accordingly. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow.